China, the second largest economy and population in the world. The UK's inflation woes, riding the highest wave in the G7.
The Organization for Economic Cooperation and Development, OECD, has some not-so-sunny news for the UK. It's likely to face the highest inflation among G7 countries this year. While the forecast is slightly better than before, 2.8% instead of 2.9%, it's still significantly higher than other G7 members like Canada, 2.6%, and the US, 2.2%. Remember that pesky inflation number from last month? It's still double the Bank of England's target, and core inflation is even higher, hovering around 5.1%. This sticky inflation, especially in services, is giving the Bank of England a headache, as interest rates remain at 16-year highs.
But there's a light at the end of the tunnel. Kind of. The OECD predicts inflation will return to target for most G20 countries by the end of 2025. However, the UK's growth story isn't as rosy. The OECD downgraded its growth forecast for 2024 to just 0.7%, making it the third slowest in the G7. So, what's causing this inflation roller coaster? Energy prices, supply chain disruptions, Brexit's lingering effects, and a tight labor market are all contributing factors. The Bank of England might need to raise interest rates further, which could slow down economic growth and potentially lead to reduced consumer spending.
BRC retail sales sink to lowest level in 15 months. The BRC's latest report shows retail sales are cooling down, even though they beat expectations. Sales grew 1.4% compared to last year, but that's not exactly cause for celebration. It's the second month in a row of sales slowing down and the weakest growth in 15 months. The BRC blames two main culprits: the rising cost of living, which is making everyone think twice before swiping their cards, and some crummy weather that kept people indoors. The BRC expects things to stay tough for shoppers, with inflation and rising interest rates putting a strain on wallets.
China stocks rise as government plays cheerleader, chip race heats up. The Chinese stock market took a positive turn today, buoyed by government assurances and exciting news from the chip industry. Buckle up, because this story has twists and turns. Chinese authorities promised to guide investors to buy more shares, essentially pumping money into the market. This pep talk strategy lifted the market by 3.5%, but some worry it might be a temporary fix. Lighter trading volumes before the holidays could make the market more vulnerable to shocks.
China's chipmaker SMIC is flexing its muscles, planning to build next-generation smartphone chips with Huawei. These tiny titans pack a punch, boasting 125 to 300 million transistors per square millimeter. This development shrinks the gap between China and tech leader NVIDIA, especially in the AI arena. China's likely to pour more money into chip development, despite the hefty price tag and limited access to Western tech. Domestic chip production is a top priority. But challenges remain. Overcoming geopolitical tensions and ensuring sustainable growth are crucial for China's tech ambitions.
If you would like us to research a stock, please tweet at Collective REC or leave a comment here.
Like and subscribe for potential investment ideas. Become a member at www.collective-research.com.
Receive investment ideas before they are published.
Collective Research. Active fundamental research in global capital markets. Make informed decisions.